Good morning. This is Dan Liu at AmericaFirst Wealth Management. I'm the Chief Investment Officer and Portfolio Manager. Joining me today is Michael Cheah, Head of Fixed Income and Portfolio Manager. And this is AmericaFirst Wealth Management's investment outlook for the week of August 5th. We're actually recording this on Sunday evening, the 4th. So we wanted to give people some insight on what's going to be happening this week and also talking about what happened last week because it was quite dramatic and it was a very large sell-off. Mike, if you can turn the slides, please. Thank you. This is our standard disclaimer, which I've read before in the past. I'll just leave it here for a moment so people can read it. And next slide, Mike. So we're going to do something different this week based on some feedback we had from some viewers. We're going to give our conclusions and insights up front and the detail later for people who want to listen to it. In this day and age, we know people are busy. Let's give you our conclusions up front. And if you want more information, it will follow. So last week was quite dramatic, especially on Friday. The non-farm payrolls number added only 114,000 jobs for July, way below the downwardly revised 179,000 in June, and the forecast was looking for 175,000. It's also the lowest level in 3 months, and below the average monthly gain of 215,000 over the prior 12 months. So it signaled that the labor market is indeed cooling off, and the unemployment rate rose to 4.3%. So the next sentence I say here is goodbye soft landing, hello emergency landing. And the markets sold off hard and 10-year interest rates dropped dramatically. I'll show a chart on that later. And also over the weekend, we learned that Berkshire Hathaway halved their Apple stake significantly. And they boosted cash to $277 billion and got very defensive. And as we know, Warren Buffett is no fool, and for the size of assets he's managing, for him to make that dramatic move, it's a large statement in terms of what they think about valuation of the equity markets and even in technology stocks by reducing their Apple stake and raising cash dramatically. So the caution flags are flying quite dramatically, and we would concur with that. Mike, next slide. For those who listened in last week, this was one of our last slides that we showed, the S&P 500 total return by calendar month, 1950 to 2024. And we did highlight that the months of August, September, and October are dangerous months because market has tended to be much weaker in those months. So we highlight that caution again, and I think this year will be no different. In addition, we have in the Middle East, no lack of conflict there, as Israel hit 2 targets recently, the head of Hamas and another Hezbollah leader. So there's a high alert and potential fear that Iran is going to exact some retribution or revenge in the near term. So any potential expansion of a conflict in the Middle East will obviously have a dramatic effect on oil and possibly world equity markets as well. So we are raising the caution flags, and it's a good time to be defensive. And certainly we saw during the week as interest rates dropped, defensive sectors certainly outperformed. We had utility stocks, real estate did well because they dropped in interest rates, and consumer staples and healthcare stocks. So if you want to remain in equity markets, it's probably a good time to hide out in those types of sectors. So that's kind of my conclusion for the equity markets. And Mike, if you want to turn to the next slide. These are weekly market stats. You can see them dramatically here. Small cap sold off in a large way, down 7%, and pretty much all the equity markets were down. S&P, Dow was down, Nasdaq was flat, and due to better performance in the beginning of the week, the Nasdaq 100 was one that was up the most in the equity markets. And because of the drop in interest rates, you saw the bond ETF was up the most for the week, up 2.36%. Next slide, Mike. And this is the dramatic drop in the 10-year Treasury yield on Friday, especially. You can see it's falling off a cliff. And now we dropped 52 basis points on the week for the 10-year yield. And now the 10-year yield is down 20 basis points from the end of 2023. So a dramatic drop. And I know, Mike, you can talk a bit about that move and what you think going forward. Next slide, Mike. And this is the yield curve. The orange is the end of last year. The one in the middle, the lighter blue, is as of Friday, and the purple one is as of the end of June. So you can see a dramatic drop in the yield curve, current yield curve from the end of last year. And so that's a yield curve there. And now let's turn it over to you, Mike, to tell us what's going on.
Thanks, Dan. All right, with economy, and I want to talk about the conclusion. I think that the bond market might be getting ahead of itself, and that's because the Fed has made it clear that it is they're data dependent, and I will elaborate on the FOMC statement as well as Chair Powell's press conference. From as a bond investor, bond price is a matter of supply and demand, and I continue to be fearful that there's going to be a lot of supply coming in, and the deficit is out of control. Right now, we have some retail buying domestically. Clearly, the major foreign central bankers are not supporting this bond market. So these are the main items that I'm looking at, and I want to go into the details. As similar to the 10-year yield chart that Dan has shown just now, we have seen this movie before, where the market ran ahead of itself. And on this chart, I'm showing TLT, and you can see how we had this dramatic move up here when the Fed made the first mistake of signaling a series of cuts. And subsequently, when they backpedal, TLT came off, and now we're making another rush up here, right? Yes, the economy is showing signs of weakness. For example, the ISM manufacturing PMI came in below consensus, and the more important, below the 50 line, signaling that the economy is in the contraction. And when the job data was released, a lot of people got very excited with the SAM rule. Basically, it posits that if the 3-month moving average of the unemployment rate rises by 0.5% percentage points or more above its lower level in the past 12 months, is a powerful signal that the economy is already in a recession. The question then is, besides looking at the average, what are the ranges, and how does one position the portfolio if and when we get a recession? So here you have the SAM rule triggers 0.5, And you see this small little uptick here, right? So this is the SAM real-time data, 0.53. Right? The market get excited that this has been triggered. And if we were to do some research using historical data, we see the following episode has been identified using the real-time SAM rule indicator. By real-time, we are talking about using data during the time, but not the revised data that we see subsequently, right? And this is the unemployment change with the latest episode comparison. If you look at the red line, this is the latest unemployment change. We see this drop here, and the SAM rule has been triggered. And historically, if you look at the dark green line here, median unemployment rate change. So after the SAM rule triggered, on average, using the past several episodes from 1960 all the way to May 2020, on average, we see the unemployment rising. Right? However, having said this, if we look at the plus and minus one standard deviation, we see a very large range, meaning that there have been instances where the unemployment rate rose a lot more than the average. And surprisingly, it had also been occasion where the unemployment rate subsequently declined further. Right. I think when we look at historical data as the base to forecast the future, we need to ask ourselves what has changed, right? And heading into the next few months, the next few years, I think one significant change from the historical data is that this time around, we have a couple of very interesting background. The first one is the recent episode, recent year or two, where businesses could not find workers. They could not find workers, especially the skilled workers. So would these businesses be willing to fire workers with the understanding that they may not be able to hire these workers back if the economy did not go into recession or if it's a brief recession? So the hoarding of workers is likely to be real. Secondly, I find it very strange that the millennials are now the biggest cohort, right? But yet we cannot find young workers, right? And I'm constantly asking the question, where are all these young people, right? Why are they not in the labor force, right? So the third major factor is the reshoring, right? Reshoring means that we are building factories here, and we cannot just run it with robot and ChatGPT. We need people, right? So these are three main factors that make me kind of hesitant to expect the unemployment rate to be rising sharply. Next, we have inflation. And again, if you look at the average of the last few episodes, historically, inflation after the trigger would continue to decline. Again, if you look at the plus minus one standard deviation, there have been occasions where the unemployment, where the inflation rate actually went up again, right? So here again, I ask myself, what is different this time? Obviously, we are still dealing with a couple of mega trends for inflation. The first one is ESG. ESG, it means a major departure from using the cheapest, lowest cost input. Like companies are now more responsive to what society is demanding of them. And in general, that means higher cost, number one. Number two, I mentioned reshoring. Reshoring means that we need a lot of materials here. And number three, we have OPEC and specifically Russia and Saudi are not very willing to allow oil price to drop. If and when they see signs that we're going to get into recession, I am of the opinion that they are more likely to cut output and support oil prices, right? So these are the mega trend, and of course we talk about labor just now, right? So these are the four mega trends that I worry that we may not get the kind of sharp drop in inflation that we have seen on average historically, or the significant drop here. And this chart shows the Fed funds rate change. And you can see again on average, right, the Fed will cut rate rapidly. And they had an occasion where, unfortunately, the Fed have to reverse and raise interest rate. Right? Now, I want to elaborate a little bit more on the SAM rule. And here I'm showing you the chart where yes, the unemployment has gone up, but we are still below NAIRU, right? We are still below the red line, the non-cyclical rate of unemployment. What does that mean? That means that so long as we are under this, we are overemploying people. We are overemploying people, and there is no slack. There's no slack in the economy, right? And if you see in the past, where the time when we're in recession is where the unemployment rate rises above the NAIRU, right? So we are not there yet. So the question then is, will the Fed be willing to jump the gun? Are they prepared to raise rate if they are wrong? And what would that do to their credibility, right? Here I am showing you the initial unemployment claims, right? Initial unemployment claims. Yes, you see an uptick here, but the rule of thumb that I follow quite closely is the magical 350,000. 350,000, right? Whenever we get above 350,000, that's when we get into a recession. Okay. We are way up below 350,000, right? We are now at only 238,000, right? So I think this kind of data would make the Fed very careful about not jumping the gun, right? This suggests the economy is labor force, right? The labor market is still extremely tight, right? And I also want to remind myself that the economy was very, very strong in second quarter, running at 2.8%, bearing in mind that our potential GDP is 1.8%, right? So we were growing at 2.8% and our potential GDP is 1.8%. So we have been running way ahead of potential GDP, and the Fed will want to see some kind of overshoot on the downside, right? Because GDP number, like most data, it goes in a zigzag manner. So moving on to monetary policy, right? And this is the Fed latest statement. Changing remains strong. Job gains have remained strong. They change it to moderated, right? And the key word is job gain, right? We are not having job losses as we had typically seen in a recession. We are not in the job losses stage, right? And unemployment rate has moved up, okay, but remains low, right? There has been some modest change to some, okay? So there's a more conviction here. The employment inflation goals have moved towards, okay, they changed it to continue to move into better balance, right? And I think the last sentence here gives the market a lot of excitement because the Fed have tilted their focus from targeting inflation to a more balanced attitude, right? So yes, the needle had moved, but I don't think the Fed is talking about going all the way to fearing recession. And the follow-up comment in the press conference was very interesting. I want to highlight two sentences here. Chair Powell talked about the downside risk to employment mandate are real now. The time is coming when it will be appropriate to dial back that level of restriction so that we can address both mandates. It's going to be inflation data. It's going to be employment data. It's going to be the balance of risk as we see it. It's going to be a totality of all that. It's just a question of seeing more good data. So, so the Fed is very data dependent, right? And the market, I think, is running ahead of itself by expecting a cut in September. Typically, a good central banker would want to warn the market, right? One meeting before the actual action, right? And well, the Fed didn't do it this meeting, right? So the fear, the possibility is that in their discussion they may argue that if they have the data, they may argue that if they act without warning the market, it may appear as if they're panicking, right? Central bankers do not like to panic the market, right? And on the data, if we were, basically the Fed need to see both set of data are good. And if we use a simple 10-year-old way of thinking, 10-year-old kid way of thinking, 50-50 chance of good inflation data and 50-50 chance of good job data. So 50% there is a good inflation number and 50% a good job data. So that gives it a 25%, right, probability. If it's one good, one bad, it's unlikely they would go ahead. Because the fear is that if they cut rate too soon, they have to raise rate. And that is terrible for any Fed chairman's legacy. Well, we had talked about the economy. We had talked about monetary policy, on how the Fed is data dependent. And now, as a bond investor, we put in a lot of effort on understanding fiscal policy. After all, the bond price is a function of supply and demand. Right now, we have a flight to quality. We have people understandably moving out of risky asset into the safety of treasury bonds. The big question is, in the absence of foreign central bank buying, is this domestic buying sufficient? Would they stay long enough in the bond market before something spook them and they sell what they bought? On the supply side, unfortunately, we continue to see there is a total lack of political will to curb the deficit. And obviously, going into this last half a year, for half a year, 4 months, 5 months, into the end of the year, is unlikely that the Democrats would want to do anything to stop spending. If anything, they may spend even more, right, into the end of the year before the election. So what are we looking at here? Look at this chart here. We look at contribution to U.S. federal outlay, and look at the total. Like we are going close to 7 trillion, and some small improvement. But if you were to look at the mandatory spending, this orange line here, we're talking about Medicare, Medicaid, right? So these are the items that cannot be cut. And as we go into a period where the baby boomers are retiring, and in a positive manner, they are living longer, and therefore government need to spend more money on them, and that's why we see this increase, right? At the same time, if we look at discretionary spending, right? It is also on the rise, right? The other item that is going to be more and more significant item is the net interest, this green bar here, right? Notice how they were pretty much negligible in the past, and this is now a rising portion. And given how we are going to roll over some of the maturing debt that were issued at very low interest rate into a much higher interest rate coupon rate, this is going to add on to the government spending. And all this means increasing supply. A proper way to look at the federal outlay is a share of GDP. And what we are seeing is that the outlay as share of GDP went up to as high as 30%. And now we are about 25%, right? So, so government is a very large part of the US economy. And if we look at the contribution of US federal discretionary outlay, what we are seeing is that the non-defense item has remained pretty much unchanged, right, in proportion. And the hope is that perhaps there could be less spending, there could be some cuts in non-defense or defense, right? And as we can see here, as a percent of GDP, right, the defense spending has actually declined, right? And therefore, it's not that easy to reduce it further, given the conflict that we are seeing around the world and the US involvement directly or indirectly. This could also suggest that we may have even more spending on defense, right? And when we look at the mandatory outlay, we see this big part here, right? This is our Social Security that I talk about. And then we have Medicare, which is rising, right? And Medicaid, the green color is also rising. And then you have the income security, right? So the trend is rather shocking, right? And there's nothing can be done to reduce this. Okay? So that's what I have for all of you on the fiscal policy side. And now over to you, Dan.
Thanks, Mike. Very interesting discussion. A lot of great data, and I think you brought it all together in terms of discussing what the Fed might be thinking here. And certainly your perspective as a former central banker adds a lot of valuable insight here. In terms of what we saw on Friday with the big sell-off in equities and the drop in interest rates, so it seems more like, after listening to you, that the reaction in the markets was more of a risk-off flight to safety, and the long-term treasury bonds seem to be the beneficiary of that flight to quality. However, as you point out, we're kind of caught between a rock and a hard place here, because if the Fed does drop rates dramatically, that's going to spike up in inflation, and then we're back in the same predicament all over again. But at the same time, the Fed has to be thinking about the economy rolling over into recession, and they have to ask themselves, what is the lesser of the two evils here? And it's very tricky, very difficult balancing act. But like you said, the Fed is data driven. And the real question for investors will be, which set of data is more important, and where are we in the cycle? So that's and as we all know, we're stuck. We're stuck here right now in the election year cycle in August with a number of uncertainties here. So and as we all know, Donald Trump has warned Jerome Powell and the Fed not to cut rates to sway the markets or influence it in a positive manner, and we'll see if Powell heeds Trump's warning there, or he's going to do what is right for the economy. And I hope Powell will do what's hopefully right for the economy, and hopefully it will have the desired effect of avoiding a recession. And like your data suggested, we might already be in one, but hopefully it doesn't accelerate towards the downside. And as we know, companies will tend to accelerate the cuts if they think things are going to get worse. And we're talking about job cuts. But if things are going to get better, usually they like to see top line improvement and growth in sales and revenues before they start hiring again. So it's the way I see it, if anything happens, any policy changes will have a lag effect rather than a leading effect here. So we'll have to get through the elections first, is my opinion. So anyway, turning back over to stocks, this is a Magnificent Seven we've been showing with regularity. All of the names were down except for Meta, which had a decent earnings report, and the concern about them having to spend excessively on AI infrastructure without really showing a lot of growth for it. Zuckerberg, I thought, did a very good job in calming investors' fears, and they'd rather be right in building their infrastructure because they know that the demand's going to be there down the road, and it will have a significant impact to their business. So I think Meta did a very good job of explaining that. And you can see that month to date and quarter to date, we're getting into trouble zones for the majority of the Magnificent Seven names. A number of them are now down double digits. For the year to date, we still have 6 out of 7 of the Magnificent Seven names up, Tesla being the only one that's down. Next slide, Mike. The sector performance, as I said at the beginning of this presentation, that markets will likely going to shift to defensive sectors. With the drop in interest rates, obviously utilities and real estate were the beneficiaries of the sector performance of the week. Meta, being in the communication services, kept that sector in third place. And otherwise, staples would probably have been the third best performing sector. And healthcare, also another defensive sector, being a safe haven for equity investors. And certainly everything else fell quite hard for the week. So it'll be very interesting to see what happens this week. The action in the Asian markets, I think Japan was down 12% yesterday. Will get investors concerned, and futures are down very sharply this morning. Next slide, Mike. The factor performance, I'm not going to go through this in much detail. Pretty much everything is down, and the higher risk qualitative and style factors were down the most. Small cap momentum were down, and no real places to hide except probably in high quality utility and defensive names. Next slide, Mike. The commodities also sold off pretty much for the week. Gold and silver were safe havens as expected. Coal and ethanol was up slightly, but pretty much everything else was down. Next slide, Mike. Agricultural commodities followed suit, except with the exception being wheat and cotton. Everything's turning into red. Looks like a global risk-off situation occurring here. And the question will be whether or not the Fed decides to do something before the September Fed rate meeting, or they're just going to wait it out here. I'm not sure if the markets are going to force the Fed into an earlier action, but obviously the Fed does watch the markets, as does everyone. So it will hopefully things reach a level where it stabilizes, but but after seeing the headlines on Friday and over the weekend, it's time to probably take some risk off the table. If you haven't done so, it might be a little too late, but I wouldn't dramatically cut losses at this point. I would focus on shifting sectors. We were fortunate in that we did take some nice hedging positions last week, and I think it's going to add some value this week. Next slide, Mike. The economic calendar, ISM services will be important this morning. Next slide, Mike. And then Wednesday always being the day full of a lot of data. It's pretty much the same information we're looking at. We'll be watching energy inventories closely to see if there are any dramatic changes there as we're moving to the month of August, and we'll see what happens there. If there's been a lot of demand in gasoline, especially, I know consumers are paying attention to gas prices, which seem to have been stable this summer. So we'll be watching for any changes in inventory that might dramatically change price there. Next slide, Mike. On Thursday, oh, I forgot to mention on Monday, we have Fed Governor Daly, who's the head of the Fed Daily speech, 5 p.m. That's the only Fed governor that's speaking this week. So she's the head of the San Francisco Federal Reserve. So we'll be listening to hear what she says here, especially with the market reaction on Friday and pretty much today. I'll go back to Thursday, Mike. Thursday, we have a bunch of auctions. Big number will be obviously the 8:30 initial jobless claims to see if the jobless claims spike up. Obviously, unemployment will probably continue to rise. The consensus is for 250,000. A forecast of 247,000. The previous claims number is 249K. So we're looking for flat changes in initial jobless claims. If that spikes up, you can expect the markets to continue to go down. All right. And I apologize. And then Fed Barkin is speaking at 3 o'clock. So we have another speech at 3 o'clock by another Fed governor on Thursday. So we have 2 Fed governors speaking. So we'll be paying attention to both of those. And then Friday, very light data, Baker Hughes rig count. So probably a sigh of relief from economic data and Fed speeches. Next slide, Mike. And then this is the S&P 500 companies and we're just focusing on the larger ones over 100 billion market cap. The bulk of the larger cap earnings came last week. Next slide, Mike. And so this week, in terms of the names that are over 100 billion market cap, just got a handful. Tuesday, pre-market Caterpillar and Progressive, which is an insurance company. Tuesday, Amgen after the markets and Uber. Wednesday, pre-market is Disney, and Thursday during market hours is Eli Lilly. So that's it for earnings from the larger names. There are quite a few of the names that are under 100 billion market cap, but too many to list here, and we don't want to waste much time on that. But we will be focusing on that. And next slide, Mike. And to close it out, as usual, if anyone would like any additional information or a copy of the slide deck, please contact Cleveland Ashley. His number and contact information is listed here. And we thank everyone for joining in. Obviously, we like to report better news and hopefully more positive outlooks, but we feel our job is to call it as we see it, paying attention to data and trends and our experiential outlook on things. And as we've been hinting at for, I think, 2-3 weeks now, the market felt weaker, looked weaker, and acted weaker. And certainly with the large amount of data that was released last week, we finally hit that tipping point. So hopefully there were some investors out there that paid attention to our warnings and took the appropriate actions and are able to run into some positions that are hedging or protecting their wealth. So with that, hopefully we will look forward to better news as we move towards the end of the summer into the fall. But most likely, we probably don't expect any dramatic change in direction. Hopefully we level off at some point, and we should, once valuations reach a period where there's a greater margin of safety. But for now, it's probably going to be a bit of a distribution in the equity markets, but longer term, I think as we come out of this, there'll be some great opportunities. And as we look back at certainly our careers and the history of the markets, every sharp drop in the markets has led to opportunities, and this time will be no different. So for those who have dry powder, it'll be a good time to be shopping near the bottom for some great ideas. And when things do recover, as they always do, there'll be higher highs ahead. So with that, Mike, if you have anything to add.
Just two things, Dan. The first is that, our work involved looking at the long term, the mega trend, and because we are very small, we are nimble enough to focus quickly on the things that change suddenly. Like this week, it's a very volatile market, and we have the flexibility, to talk quickly and act quickly. That's our strength. And on the short-term thing, what's in my mind now is the disease and the cure, right? The question is how bad is the economic slowdown, and how fast can the Fed come in with a cure? With 25 basis every week enough? That is an important question for the Federal Reserve. And as they ponder how they should react to the disease, they should also worry about the perception of the disease, right? Because if they were to panic and cut too much too quickly, that may send fear to a lot of investors and market participants and businesses that things could be really, really bad for the Fed to act like this. And as you mentioned just now, Dan, companies are also watching this, and if they are panicked enough, they may cut labor force, and that would create another layer of negative feedback into the economy. So these are all the complications and the details that we have the luxury to focus on this very quickly, just because we have a small team.
Yep. Okay. I wanted to mention also that one of the positive things we saw was that mortgage rates hit a low. I think we haven't seen rates drop down this much recently. So if we get some pickup in the real estate markets, especially with home buying and home construction, we would deem that definitely a positive, because it does show that despite the drop in the markets, there still are a lot of households that still have the wherewithal and the need and desire to go out and purchase a house. And that would definitely be a positive. And some of the data that we looked at previously did show that household balance sheets are still quite strong. So with most American households under leveraged, hopefully there will be enough of them that were waiting for this drop in interest rates to finally make the move and purchase a home. And we'll be watching for that. That would definitely be a positive. So anyway, without us droning on further, we'll let everyone get back to their day, and feel free to reach out to us if you have any questions or comments. Thanks for tuning in, and have a great week, everyone. Bye-bye.
Bye-bye.
Okay, Mike, I think we lost you there.